Money Master the Game: 7 Simple Steps to Financial Freedom by Tony Robbins. Key takeaways. Number 1. Make the most important financial decision. Automate your savings. Remember the golden rule. He who has the gold makes the rules. Compound interest is key. By automating your savings and investments, you harness the power of compound interest, which Albert Einstein called the most important invention in all of human history. This approach allows your money to grow exponentially over time, potentially turning small contributions into significant wealth. Start early and be consistent. The earlier you start saving, the more time your money has to grow. Even small amounts invested regularly can lead to substantial returns over decades. For example, investing just $300 per month at a 7% annual return for 40 years could result in over $1 million. Automate to overcome human nature. Our emotions and short-term thinking often sabotage our long-term financial goals. By setting up automatic transfers to savings and investment accounts, you remove the temptation to spend and ensure consistent progress towards your financial objectives. Number 2. Debunk investment myths and become an insider. You don't get in the game unless you know the rules. Understand the truth about mutual funds. Most actively managed mutual funds fail to beat the market over time, yet charge high fees that significantly erode returns. By understanding this reality, investors can make more informed decisions about where to put their money. Learn about hidden fees and their impact. Many financial products have hidden fees that can dramatically reduce your returns over time. For example, expense ratios, transaction costs, 12b-1 fees, soft dollar costs, cash drag. Seek fiduciary advice. Unlike brokers who operate under a suitability standard, fiduciary advisors are legally obligated to act in your best interest. This distinction can make a significant difference in the quality of financial advice you receive and the products recommended to you. Number 3. Calculate your financial goals and create a winnable plan. For things to change, you have to change. For things to get better, you have to get better. Define your financial dreams. Clearly articulate what financial security, vitality, independence, and freedom mean to you in concrete terms. This clarity will provide motivation and direction for your financial journey. Create specific, actionable goals. Break down your financial aspirations into tangible, measurable objectives. For example, financial security, $50,000 a year passive income. Financial independence, $100,000 a year passive income. Financial freedom, $200,000 a year passive income. Develop a realistic plan. Use tools and resources to calculate how much you need to save and invest to reach your goals. Consider factors such as inflation, expected returns, and your current financial situation to create a feasible roadmap to financial success. Number 4. Master asset allocation for long-term success. Diversification is the only free lunch. Understand the importance of asset allocation. The way you distribute your investments across different asset classes, stocks, bonds, real estate, etc., is the most critical factor in determining your long-term investment success. Proper allocation can help maximize returns while minimizing risk. Balance risk and reward. Divide your investments between security and risk growth buckets based on your personal risk tolerance and financial goals. This approach helps protect your wealth while still allowing for growth potential. Implement the dream bucket. Allocate a small portion of your portfolio to investments that excite you and align with your passions. This can provide motivation and enjoyment on your financial journey while still maintaining a responsible overall strategy. Number 5. Utilize the all-seasons portfolio for consistent returns. It's not about predicting the future, it's about preparing for all possible seasons. Understand the 4 economic seasons. Ray Dalio's approach recognizes 4 potential economic environments: 1. Higher than expected inflation. 2. Lower than expected inflation or deflation. 3. Higher than expected economic growth. 4. Lower than expected economic growth. Implement the all seasons allocation. Based on Dalio's insights, consider the following asset allocation: 30% stocks, 55% bonds, 15% intermediate term, 40% long term, 7.5% gold, 7.5% commodities. Rebalance regularly. Maintain the target allocation by periodically selling assets that have grown beyond their intended percentage and buying those that have shrunk. This disciplined approach helps manage risk and can potentially enhance returns. Number 6. Implement strategies to speed up your path to financial freedom. Don't wish it was easier. Wish you were better. Save more and invest the difference. Look for ways to reduce expenses and increase your savings rate. Even small increases in savings can significantly accelerate your progress towards financial goals. Earn more and invest the difference. Seek opportunities to increase your income through side hustles, career advancement, or entrepreneurship. Commit to investing a portion of any additional earnings. Reduce fees and taxes. Minimize investment fees by choosing low-cost index funds and ETFs. Utilize tax-advantaged accounts like 401ks and IRAs to reduce your tax burden and keep more of your money working for you. Get better returns. Educate yourself about investing and seek opportunities for higher returns without taking on excessive risk. Consider strategies like value investing or dividend growth investing. Change your lifestyle. Consider significant lifestyle changes that could dramatically alter your financial trajectory, such as relocating to a lower-cost area or downsizing your home. Number 7. Create a lifetime income plan for true financial security. The goal in investing is to get the maximum net return for a given amount of risk. Understand the importance of lifetime income. Creating a reliable stream of income that lasts throughout retirement is crucial for true financial security. This approach protects against the risk of outliving your savings. Explore income-generating strategies. Consider options such as dividend-paying stocks, bonds and bond ladders, annuities, carefully selected, real estate investment trusts, REITs, rental properties. Diversify your income sources. Don't rely on a single income stream in retirement. By creating multiple sources of income, you reduce risk and increase financial resilience.